I'm tonight chatting to you about, I've been asked to speak about the tax-free savings account. And as you'll see on my first slide, I've been quoted as saying it's kind of a no-brainer. I think everyone should have one. So let me take you through a little bit why I think that. And a couple of things I want to cover tonight is literally what is the tax-free savings account, how it works. Some of the fees. Not all products are made equal in this space. Some are more expensive than others. So I just want to go through what the fees, what you can expect to pay on a tax-free savings account, how much you can put into it, and how you should invest, whether you can add it to your existing normal trading account or investments, who can get involved in the tax-free savings account, whether it's for you or your children. A couple of myths. I want to explore a couple of myths about the TFSA. There's 6 myths, particularly I want to talk about, and then why I think everyone should have it. As I said, I've been quoted as saying it's a bit of a no-brainer. So let's get into what is the tax-free savings account, and hopefully everyone's got my screen there and it's shared with you. So I'm not going to read it. I'm going to talk to it a little bit, but clearly we all understand that there's a problem with savings in South Africa, and that literally, as the stats say, 51% of South African pensioners just don't have enough money at retirement. And literally, this was a government initiative. They were saying we're not saving enough. So how do we incentivize saving? Instead of make it compulsory, how do we make it voluntary? And how do we give you a couple of perks to make sure you save? And how do we make it cheaper? How do we make it tax effective? So you can see there, what they've done is they've allowed you to invest 30,000 per year, up to a maximum of 500,000 over your lifetime, into what's called the tax-free savings account. And a little bit more about that just now. So the product that we've launched, I sit on the JSE Retail Advisory Board, and one of our projects has been in collaboration with the JSE and many other brokers. We've designed, or the JSE's come up with, a tax-free savings account using an equities account. And this has been very well supported by the JSE. As you can see, I have a quote there from Ziona Jacobs, the director at the JSE. And very much the JSE has been very useful or very helpful in designing these products, because they went in there and discussed this with National Treasury. They talked to Straight. They've talked to BDA. They've managed to bring the fees down considerably on these accounts. So some of the things that the tax-free savings accounts do for you, okay, and as I've put there, the 8 reasons why I believe you should join the tax-free savings account movement is, first of all, you pay no tax. But clearly, you pay no dividend tax, you pay no income tax, and you pay no capital growth tax. So that's quite useful. That means that more of your hard-earned winnings or earnings on your investment is retained. Via the JSE tax-free savings account, you've exposed it to the stock market. Limited exposure, and I'll get to that just now. But certainly you have exposure to all the asset classes that are traded on the stock exchange. You have low trading fees, and we'll get to that just now. As I said, not all products are made equal. Not everyone has reduced the cost of their tax-free savings account, but certainly the stockbrokers have come to the party and have come up with a trading account that's quite low cost, and that of course is going to benefit you. That's why I say it's a bit of a no-brainer. If you're going to open a trading account, you might as well start with a tax-free savings account as your first trading account, because it attracts a lower fee. But more about that just now. And also, depending on how you buy this, you should have no initial upfront fees. So when you invest all your capital, nobody should be taking an upfront fee from that. You don't need an advisor for this. You can contact your stockbroker and open an account. You can't have performance fees. Nobody can levy performance fees. So it's the slide says virtually free. It's not quite free. There are some costs, but they're quite low. The other thing about, because it's a stockbroking account, you will get research from your stockbroker. So you have access to some of the best stockbrokers in the market and their analysts. You've got quite a wide range of exchange-traded funds that you can select from, and I'll come back to that in a minute. And, of course, you have easy access to your funds. The tax-free savings account is not embargoed to retirement date. You can dip in and you can help yourself to those funds if you need it. But understand there are some repercussions from that, and more about that later. And then transparency. What's quite good about a stockbroking account is that you can log in, you can see what you hold, you can see exactly the growth in all your underlying investments. So very, very transparent. So the first big advantage is of clearly you get exposure to the JSE. So let's unpack that a little bit. Let's see what you actually get, which ETFs are available to you. So if you go onto the JSE website, that's jse.co.za /tax-free, you'll be able to see that there's a whole list of exchange traded funds that you are permitted to trade. National Treasury has limited us not to shares, but exchange traded funds. So those are unit trusts that are listed on the JSE. We're unfortunately not able to use the whole exchange traded product universe. So we can't include, for example, exchange traded notes, commodities, these sort of things. But at least it's a start. We've got over 30 exchange traded funds there. And you can see they're both domestic and offshore that you can choose from and add to your portfolio. And some of those brand names you'll recognize there, like CoreShares, the Satrix products, some of these you'll recognize. So we were asked by the exchange, like any other stockbroker, to come up with some products, and we decided to come up with 2 specific products for our clients. The first one we've called the Vunani Life Stages tax-free savings account, and why it's called Life Stages is because as you mature through life, your risk profile changes. So you actually want to change your asset allocation the older you get. And I'll touch on an example of that just now. So the first product, as I say, is a Life Stages product. And the Life Stages model is very simple. When you're young, which I'm no longer, when you're 18, 20, you can take a lot of risk because you've got a lot of time to retirement. So you can look at a very aggressive growth type portfolios. So high weighting of equities, very low weighting towards bonds, property, cash. So you're probably sitting, close to almost 100% in equities. But as you get older, and there's a rule of thumb out there, which it used to say, take 100 and minus your age, and that's typically how much equities you should have in a portfolio. But as people have started to live longer, that rule is about 113, 115 minus your age pretty much gets you your equity component. So you can see from this graph the glide path. When you're younger, lots of equities in your portfolio or growth assets in your portfolio. And as you get older, you want to slowly but surely diminish or decrease the amount of equity exposure and bring up the other more conservative asset classes, bonds, listed property, etc. So that's exactly what we've done. We've created, to start with, and we've only started with 3. We could add a lot more in the future, but we've started with 3 life stage options. So we have a conservative. Risk profile is low, moderately low. We have moderate, which is in the middle, and aggressive, which has got a medium to high risk type portfolio. And you can see the benchmark on these is CPI plus 3, so that's inflation plus 3. So in the conservative portfolio, you want to be outperforming inflation by about 3%. And in the aggressive portfolio, you want to be outperforming inflation by about 7%. So you can see a conservative portfolio, if you're 50, 55 years plus, you probably want to be in a conservative portfolio. But if you're young and nimble and you've got a lot of time in the market, you want to be in the aggressive portfolio. And if you're sort of my age, you're somewhere in between. So let's just unpack each of those portfolios a little bit more. So the conservative one, offshore equity, we do include it. You can see equity sits at about 40% of the portfolio. So the equity component is low, but it's still there. I mean, it is your equity component is your engine in your portfolio. You can see the non-equity component, that's bonds, cash, property, listed property, is sitting at about 60%. Well, it's sitting at 60% in the portfolio that we've constructed. You can see that our offshore versus local, we have 10% domestic, 90% domestic and 10% offshore equities. And then you can see our spread of asset classes. We've included bonds, cash, local property, offshore equities, local equities, and we have 0 in prefs in this portfolio. So that's how we've constructed the conservative portfolio. So if you contact our trading desk and you say, hi, I want to buy the Vunani Life Stages conservative portfolio, this is exactly what you'll get. You'll replicate this portfolio. The middle one, as I said, is moderate. It's more for the 36 to 55-year-olds. We're trying to get you inflation plus 5. And that looks a bit like this. It's got about 20%, 22% offshore. Here you can see we've got a lot more equities now. We're sitting at almost 60% equities. 57% equities to be exact, and that's split 22% offshore, well, 21.5% offshore, 78.5% local. Once again, a nice spread of asset classes, both between property, bonds, international and domestic. And then the most aggressive of our portfolios, the aggressive portfolio, this is looking at about CPI plus 7. So if inflation rate is sitting at 6-7%, you're looking to do about 13 to 14% per annum is what we'd sort of be benchmarking. And you're looking at equity exposure at about 70%. Between 70-75% is how we design it. And this is more for the sort of younger crowd who can take on more risk. So you can see currently our portfolio is sitting 70% equities, of which 25% is offshore. So we've taken our full allocation offshore. And the reason for that is we think there's a huge investment universe out there, and we think you need protection against the currency. So you can see where 75% of our equity component is local and 25% is offshore. And you'll see here, once again, we've got a bit of cash, bonds, property to make up the other bits. We've got no preference in this preference shares in this portfolio. So that is our Vunani Life Stages portfolio. The other, and you can choose one of those 3 products depending on your risk profile. And you can have that discussion with our trading desk and say which of those 3 is the most appropriate for you. If, however, you know your stuff and you want to trade yourself, you can open what we call the flexible or do-it-yourself TFSA trading product. And this one is where you can once again select any of these and trade in and out of these. So if for the moment you like financial stocks, you could buy the Satrix Fini. Or if you wanted to go offshore, you could trade the Deutsche MSCI World Index. And you can buy in and out of these. If you're starting to worry that there is a Greek meltdown or Greece exiting the Eurozone, you might want to exit equities completely and rather have some pref shares, some bonds, some listed property in your portfolio. So you could really pick and choose on this. And once again, as I said, you can go onto the JSE website, jsc.co.za, tax-free, and you can have a look at the selection here. Or you can phone your stockbroker. You can phone our guys, and you can have a chat about which of these you want to invest in. So this is very flexible. You can buy and sell in that portfolio. So whether you choose the Vunani Life Stages TFSA or the flexible trading account, basically you are owning the best JSE listed companies. You're not just owning, but you're not owning them directly. You're owning them via exchange traded funds. And if you choose to go into the offshore ETFs, you effectively have exposure to 1,900 offshore companies via the MSCI Global, MSCI US, MSCI Europe ETFs. So that's a massive spread of shares that you can get access to. I see there we can also add in domestic liquid property, a spread of government bonds, and of course preference shares. I just want to check whether we still have you, because I see that audio connection has been lost. Let me just check with one of my colleagues whether he's still hearing me. Just while I'm waiting to check whether their audio connection seems to be back, I forgot to mention at the beginning that I'm, of course, open for questions. And you can log any questions, and I will get to them at the end. And more than happy to answer any questions on the tax-free savings product. And if you've got any market questions, I've got some of my stockbrokers in the background here, and we can always put them on the line if you want to ask some general questions. So I believe our connection is back, so let's carry on. So as I said, we have 2 main products, the Life Stages TFSA and the flexible trading account. But out there in the market, there are a plethora of other products that you can look at, but these are specifically the Vunani ones. So in terms of costs, and we chatted about that just now, we've pitched the TFSA. We think the JSE has done a very good job of bringing down the costs from their side on these products. So the brokers, to a large degree, have come to the party. Most brokers you will see will have dropped their admin and management fee. So on our Life Stages product, you can see we're charging 0.4% or 25 Rand a month. And our flexible, which is the one that you trade yourself, we're charging 25% or 25 basis points or 25 Rand per month. You'll see the brokerage rate has been reduced down to 25 basis points. Our normal brokerage rate for retail clients is 50 basis points. So at 25.25%, it's literally half of what you would normally pay. And then, of course, there's a reduced straight fee, BDA costs are lower, etc. So all in all, as I said at the beginning of the presentation, bit of a no-brainer. Because for your first 30,000 per annum, you might as well open one of these accounts to do your trading, for your exchange traded funds, because it's half the price. So I've been asked to chat about the 6 myths, and I thought, sometimes it's better to go out there and see what everyone else is talking about the tax-free savings account. And Nikki Giles from Signia had done my job for me. She wrote a fantastic article on MoneyWeb about the 6 myths. So I've adapted the next couple of slides from the interview with Nikki Giles. Signia have got some great products on their platform to give them a bit of a punt. They also have a tax-free savings account. And she was interviewed by MoneyWeb, and she went through what she considers to be the 6 myths. I'm going to talk to them a little bit, and I'm going to probably add my own angle to it. But the first myth, you don't have access to your money until a future date. Well, this is completely incorrect. This isn't like other pension provident fund type products. Here your money is available to you, but it comes with a caveat. If you put your 30,000 Rand in per annum and you dip into it, you're not allowed to put it back. It won't be counted in that 30,000. So you can't replace it. So if in this year, for example, you put in 30,000 Rand, and there's a bit of an example there that you can read, but if you put in a 30,000 Rand deposit and you withdraw 15,000, you can't put it back in this year and have it as part of your 30,000. So that is a limitation, that you can't dip into this as a savings account. You can kind of understand that, because they're saying this is really a long-term savings product, and rather only dip in if you've got an emergency or you really need the money. So myth number 1 busted. You don't have access to your money. Of course you do, but it comes with the limitation that you can't redeposit that money in that year. A lot of people have thought, mainly because banks are also offering tax-free savings accounts, they seem to have this idea that your money is guaranteed. Unfortunately, if you are in the equities market or you trade on the JSE, there is no guarantees. The market goes up and down. So depending on the asset classes you select in your tax-free savings account, you could either be taking on a lot of risk, or if you're only in cash or in a fixed deposit, then you're taking on very little risk or almost no risk. So it depends on what asset allocation or asset mix you choose, whether your capital is guaranteed. So there is no guarantees on this product. Myth number 3, tax-free savings account works like a retirement annuity. It isn't a retirement annuity. And in fact, we say to our clients, look, I'm not a tax advisor, I'm not a wealth manager, so you really need to take tax advice on this. But we would suggest that if you are a client that is earning a reasonable salary, you should fully utilize your retirement annuity first, because it has got a great tax benefit for you before you look at the tax-free savings account. So it isn't there, in our opinion, to replace the retirement annuity. It is there to add on top of your retirement annuity. However, that being said, because the tax-free savings account comes with lower trading costs, if you are going to open up a trading account, you might as well open up the first 30,000 in the tax-free savings account anyway, because of the cost saving. There's a couple of other things that you've got to watch out that an RA gives you that a tax-free savings account doesn't. The RA does not form part of your estate, whereas a tax-free savings account does. And simply what that means is, if someone wants to attach your assets, your tax-free savings account can be attached. So if they come looking for assets, this will be deemed part of your estate and part of the assets that they can attach, whereas the RA can't be attached. Tax-free savings account are the most cost-effective way of saving. Myth number 4. Well, we think as a stockbroking account, it's pretty good. At 25 basis points brokerage, we think that's a good deal for you. However, have a look at some of these products, because some LISP and platform providers have really just taken normal products and dressed them up as tax-free savings account, and they're still charging 125 basis points and advisor fees on top of that. So that's not particularly cheap. So it isn't a low-cost savings account. It, in fact, is quite expensive in our opinion. So once again, I'm saying Not all products are made equal here. If you come into a stockbroking tax-free savings account, the only thing you will pay is your broking fees and your admin or your custody fee or your administration fee. You're not going to pay an additional asset manager, product provider, financial advisor fees. You've got to watch for those in the tax-free savings account. So have a look at it. Make sure it doesn't, that you think you're getting a low-cost account and effectively you're still paying 200 basis points. You can't switch between product providers. Well, this myth has come about because in year number 1, to keep things simple, National Treasury have said you can't switch. But it certainly seems that from next year onwards, you will be able to switch between products. So if you're unhappy with your product provider, you can switch to another provider. So it's only in this year they've limited switching just to keep things a bit simple in the first year. You can invest in shares through the tax-free savings account. Unfortunately, shares, as in buying MTN's, Naspers, SA Breweries as a share, is not available at the moment. We certainly are lobbying National Treasury to add it in. But what you can do via a stockbroker is buy exchange-traded funds. So you have 30, 40 exchange-traded funds, which gives you indirect access to those shares. And we think that's a pretty good start. So a couple of frequently asked questions that I have been asked at other presentations. So I'm just going to run through them fairly quickly. Who can invest in the tax-free savings, the Vunani tax-free savings account? Unfortunately, it's a natural person, so you can't have a company invest. So it's a natural individual who's a South African, residential address, has an ID number and a tax number and a bank account. So it's all the usual FICA and it's limited to South Africans. May I transfer? I've touched on this one already. You won't be able to transfer in the first year, but you will be able to transfer in subsequent years. Can I withdraw funds? Yes, you can. Remember, you just can't top up in that year. So if you want to withdraw, you sell your shares like any other trading account. And at the moment, the market is what's called T+5. Your money will be available within 5 days. May I invest for my children? Of course you can invest for your children, but it's unlikely that they're paying tax. So the whole tax efficiency of the product is probably going to be wasted on them. So you might want to use it as a product to get a good savings habit going with your kids, but you are really using up that 500,000 that's available. So you might want to start until they actually have a tax problem. May I add this product to my existing portfolio? You can add it to your existing products with us, but you will need to open up a separate new account and you will need to put new monies into that account. So we need to report it separately to SARS. Can I convert an existing JSE account? No, you can't. But what you can, of course, do is sell the shares out of an existing account, withdraw those funds and use that to open up a tax-free savings account. Whether that's the greatest thing to do in terms of capital gains and tax from your point of view, you need to have a look at that with your tax advisor. And is there a maximum? Clearly, we've discussed this a few times, 30,000 Rand per annum, 500,000 Rand of your life. So at the moment, that's about 16, 17 years that you can contribute your 30,000 per annum. So how do you go about opening an account? Well, so you contact your broker. You go into our online form, you click there that you want to open up an equity account. You indicate to us that you want to do a tax-free savings account. We, of course, need your ID and proof of residence. We will open the stockbroking account for you. We'll issue a BDA account number. You put your funds in, and you're ready to either be invested in our Life Stages product or in our flexible product where you can trade yourself. And you can trade either via online or you can phone your broker. And seeing a lot of people are just starting off in their investing careers, you probably want to phone the broker and just have a chat and say, I'm buying this, got any, we're able to give advice. We are registered to give advice. So to join the Vunani tax-free movement, to get started, either contact us on our phone numbers, email us, go to our website, contact us on Facebook, Twitter, or via LinkedIn, or go to our website to trade TFSA, get started, and you'll see a little form like that. You can fill it in, fill in all your details, and one of our traders will contact you and get you started. So hopefully I've covered a little bit of the tax-free savings account. I did want to keep my presentation down to about 30 minutes, so I wasn't keeping you too long online. I'm very happy to take some questions from the audience. So far, let's see if we've got any questions out there. Okay, we've got one already. Sorry guys, just bear with me. I'm just opening this question here. You know, I not the greatest in IT here, so I'm just getting the question. Yeah, it looks like it's not me. It looks like the person posted a blank question there. So anybody who's got any questions, fire them away. Or anybody who's got any thoughts about the market at the moment that you would like to have a chat with me about. Come on, guys, don't be shy. You can fire me a question or two. I'll happily answer them. Willem, I see your question there. So let's have a look. Willem, unfortunately, your question came through as blank. Do you want to try that again? Yeah, that's a very good question. So I've just been asked whether I can do a monthly debit. Can I do a monthly contribution? So I'm going to go back a few slides just to address that one. So just bear with me. I'm going to flash through a few slides here. I'm going to take you to that slide there. So what we'd like to see in our product, and products are different out there. So you can go onto one of the list platforms, sign a monthly debit order. But what we'd like is, because we're buying underlying ETFs and we think you need a spread of investments, we've said let's put a sort of minimum lump sum deposit of 5,000 Rand into your account. You don't need to do the full 30,000. If that 5,000 is a bit of a problem, give us a call. We'll have a chat and maybe we can make a plan for you. But we think you should start up with about 5,000. And then, because we have to administer, when you put in the extra tranches of money, we've got to go and buy the underlying ETFs. We're suggesting a minimum deposit of about 1,000 Rand. So look to do about 5 grand to start off your account, and you can put in about 1,000 Rand minimum deposit. Clearly, if you put in 5,000, you put in another 1,000 each month, you're not going to get to the 30,000 minimum. You probably then are not fully utilizing the 30,000 that's available to you. I see I've lost my audio connection again, so I'm just going to wait a moment for that to come back. Let's see if we've got a few other questions. Okay, I've got a question there. Thanks from Sarah. Can I open an account for multiple kids? Yeah, certainly. You can open up, if you've got several children, you can open up those accounts in their name. Clearly, we need to just onboard them. We'll take them through the FICA process there. You know, it'll be your residence, their ID number. We would like to see the funds from their bank account if possible. So, yes, you can open up multiple accounts for your kids. I've got a question from Philip. When can I invest in shares? So I suppose, as I said earlier in the presentation, you can't directly invest in shares. You can only buy exchange-traded funds, and those exchange-traded funds are available between trading hours. So the market opens at 9 o'clock in the morning and closes at 5 in the evening, and you can trade those exchange-traded funds anytime between 9 o'clock and 5 o'clock. If you want to then send us an order after hours, you can by all means email us. You can by all means drop us a call. We're normally here to about 6 or 7 o'clock in the evenings, but those orders will only go into the market in the next morning after 9 o'clock. I see we have a question from Jaco. Jaco's clearly, I didn't explain exchange traded funds clearly enough, so a slap on the wrist there for me. So exchange traded funds are really just baskets of shares. They're baskets of an underlying instrument, so they could be shares, they can be bonds, they can be listed property, they can be preference shares. So really what they've done, the suppliers have done, is they've created this basket of shares, very much like a unit trust. In fact, it is a unit trust. It has to comply with the Collective Investment Schemes Act. So it's a listed unit trust that's on the JSE, but you buy it as one share. So you don't have to worry about picking. So the top 40 ETF, for example, you don't have to worry about picking the best 40 shares. You've already got them in a basket of shares, a weighted basket of shares. And there's clearly exchange traded funds that cover the top 40 shares. Core Shares have now launched the top 50 shares. There is a mid-cap ETF, so you can get a basket of RMB mid-cap. They do a basket of mid-cap shares. There is a bond ETF, which has a spread of bonds, and there's listed property ETFs, which has a spread of listed properties. So an exchange-traded fund, just to cover that again, is just really a basket of underlying instruments, for example, shares. Thank you for that, Jaco. John has asked me, why is there a monthly and an annual limit? Well, there isn't a monthly limit, John. You are limited by 30,000. If you want to put that in the very first month, you're done. So we don't really have a monthly limit. We have a monthly limit that we don't want too smaller deposits. It's very admin intensive for a stockbroker to have to administer 50 Rand a month contributions. And if you're putting 50 Rand in a month, you aren't going to get up to your 30,000 anyway. So really the limit is 30,000. That isn't a hard limit. You can put more than that, but you will be hit at your full 40% marginal tax rate. So it's not a good idea. Do we have any other questions out there? Let's have a look. Vic, I see, Vic, you say we've lost audio. Hopefully we've got it back. Can we, okay, I've got Vic's question back here. Can we open an account with 30 grand? Yes, of course you can. The tax-free savings accounts are available. The JSE, I believe, has already had several thousand accounts opened with them. They're doing quite well in terms of promoting the product. So yes, you can. You can go online now, fill in that form. I'll get one of my guys to phone you, send you the documentation, or click on our website and click on open an account, and we can start the process. So Vic, we're open for business. Another question, James, who I'm glad to say, James, is already a client of ours. So welcome, James. Yes, James, if you've got an existing account and you're already FICA approved, we don't have to do it again. So just drop our admin guys or our trading desk a call or an email. Just ask them to get a second account open for you, and we'll get the correct brokerage scales, etc., loaded for you. So I'm glad, James, we've at least got one account out of this evening. Okay. Mr. Pillay has asked me if we are recording this webinar. Sorry, I should have said at the beginning, it is recorded. You can go and we will make it available. We will send it out to all the participants as well, the link, so you can watch it again. I'm also very, very happy if you want to send me an email, ask me questions on any of the slides. Very happy to expand a little bit more on some of the content. Chris, good question. How will we know which are the best ETFs to add to our portfolio? Yeah, I suppose that's tricky at the moment because equities are an interesting place to be. Market's looking like it's recovering at the moment. So clearly you've seen in our portfolios, we still like equities. And within that equities, within that asset class, you know, whether you should be in mid cap or whether you should be in the top 40, we kind of like a blend of both at the moment. And in fact, to give some of the ETFs a punt, our colleagues at Grindrod via Core Shares have launched a top 50. And we like that because it gives you the top 40 shares plus a few extra nice shares. We like the top 40 concept, top 50 concept. Or you could take one of the dividend ETFs, like the Core Shares dividend product, and then maybe add some mid cap to it. But I'm very, very happy that if you want to give our trading desk a call, Koos, and they can take you through which ETFs are our preferred at the moment. Clearly, we're very underweight on bonds, property. You've seen those portfolios. We added into the conservative, but at the moment we're sitting almost full weight equities in all our portfolios. And just to go back a little bit and maybe explain why we're not 100% weighted in our portfolios. Just want to go back one, especially to this aggressive portfolio. Nobody's asked me the question, why am I not 100% equities? Well, because this product is very much retirement savings. There is this prudential guideline which says that in a Reg 28 or a pension provident fund RA type product, you shouldn't have more than 75% exposure. So we've applied that to our product rules because we think that's a good idea. We don't think you should be more than 75% exposed to equities. Also, one of the prudential rules is that you shouldn't be more than 25% offshore. So we've kept that rule in this product as well. So we've got a 25% offshore weighting and a maximum 75% equities weighting in our portfolio. And that is just a good prudential a rule. Vic, thank you for telling me the audio is back. I'm glad. At least you can hear me. I don't seem to have any new questions, guys. If you want to fire anything more, otherwise, I'm sure we can call it an evening. If you want to ask me anything about the markets. Don't seem to have any more questions. Hopefully, I've done the topic justice. It's been very great to chat with you online. I'm going to sign off. Stop the recording and we'll make it available to everybody. Thank you very much, everyone, for joining me. Have a good evening.